We are joined today for another in our series of, I guess you can call them recovery events. This one today is with our accountants, quite possibly your accountants too. I think, Scott, you might tell us more about this, but one of Scotland's foremost accountancy firms with a fairly diverse portfolio of industries that they work in. I suspect Scott will give us a bit of a spin around that. We are joined by 4 colleagues from Johnston Carmichael today, each with a slightly different focus and a slightly different specialism. There's some room for questions at the end. You can type them in the wee chatty box. And if we don't have time for them, then I think our friends have agreed that if any questions that come in afterwards, they'll do their best to field those. I would just say we are also doing another event next week, which I wanted to call the Lunchtime Lawyers. But I think Austin Lafferty might have gotten a bit annoyed about that. For you old people, you'll remember Austin Lafferty, the lunchtime lawyer. So we are doing a similar event with Harper McLeod next Thursday at 1 o'clock. And you could join these two together. So you get your finances sorted out with JC, and then Harper McLeod will make sure that you don't go to jail for whatever it is that you learned here today. So without any further ado, I am going to hand over to Scott Dunbar, who will tell you a little bit more about JC and the order of the day.
Yeah, so thank you, Laurie. Thank you for having us along today. Much appreciated. For those of you who don't know who I am, my name's Scott Dunbar, as Laurie said, and I'm one of the partners with Johnston Carmichael based in the Elgin office up here. And for those of you who don't know who Johnston Carmichael are, as you'll see in the slide here, you know, we are a firm of a certain size now, but it all kind of started about 85 years ago by 2 guys up here in the northeast of Scotland who got together and set up the firm, Johnston and Carmichael being their last names. And today we now have, from that 85 years ago, we now have the 60 partners in the firm with 750 staff, and we have 13 offices across the UK. It makes us Scotland's largest accountancy firm, and we're also one of the top 20 in the UK as well. And that size and scale gives us the ability to have many specialists across many different sectors and many different technical areas within the finance world and the business world as well. One of our sectors that we do specialise in is certainly the hospitality and tourism sector. And as you'll see in the slide there, we currently act for around 1,000 food and drink and hospitality businesses. And we also act for around 2,000 agri-businesses, which is obviously part of the supply chain within that sector, which is one of the areas we have worked in for many, many years. And as I say, we have many specialists within the food and drink and hospitality areas working in the firm. So we have that reach across Scotland, as you'll see in the map there, but we have that office down in London too. But beyond that, we actually are a member of a network called the PKF network. And that is a number of member accountancy firms across the world. And it gives us that reach of when we need to advise clients that are operating in different countries and in different areas of the world, then we can also call on them to do that. So that gives you a bit of an idea of the size of Johnston Carmichael. As Laurie has said, today we're kind of going to take a bit of an approach where we're going to talk about a few different topics. And I'm joined today by some of my colleagues who I will just introduce. So first of all, we have Tony Cochrane, who is a VAT Senior Manager here at Johnston Carmichael. And again, advises on quite a number of industries, including the hospitality and tourism. We have Nicola Horsburgh, who is a tax partner, again, with ourselves and works in the Elgin office with myself. And again, advises on a whole raft of different measures, but specifically within this sector at times too. And finally, last but not least, we have Frank Fraser, who works with ourselves in the Johnston Carmichael Wealth side of us, and is going to speak to us today a bit more about sort of pensions and a bit more around the investment side of things. So a bit of a kind of agenda for today. We've got the first topic. I'm going to take that one and just run over a bit of the COVID business support that's still in place. Then Tony's going to lead us through some of the VAT and the land taxes updates. Nicola Horsburgh is then going to take us through a bit of a tax update following budget last month and so on. And finally, Frank will take us through a bit of financial planning, and we hope we'll have a few minutes left at the end for some questions, if there are any as well. So first up then, on the COVID business support. just as a quick run through, I'm sure you probably all have knowledge of this already because it's been something that's been on the go for quite a while, but more just to talk you through that. As you'll all be aware, the Coronavirus Job Retention Scheme allows employers to place employees in furlough and apply for a grant to cover the cost of having them on that furlough. In December, the Chancellor announced that the furlough scheme would be extended till April 2021. And then in the budget last month, there was a further extension through to September 2021. The level of grant currently available to employers is sitting at, as it has been for a while, at 80%, subject to a maximum of £2,500 per employee per month. From the 1st of July, however, that will reduce to only 70% that the government will pay you. And then from August and September, it will be 60% that the government will cover. However, the employees must still be paid the 80%. So therefore, effectively in July, employers are going to have to cover 10% of the wage cost. And in August and September, they're going to have to cover 20% of the wage cost. Hopefully by then, restrictions will be eased a bit more than they are right now, and there'll be a bit more income for a lot of years, hopefully, and therefore this will hopefully that extra 10% and 20% may be a bit more, you might be able to cover that a bit better from that income. The only other thing to mention on this here is that, just another point to cover is that on top of the 80% that we pay employees every month, we must also, the employer is actually on the line for the national insurance and any mandatory auto-enrollment pension contribution as well. So that's just something else to bear in mind. And the Chancellor also announced that they extended the eligibility for the scheme. So for your months from May onwards, employers can claim for employees who were employed on the 2nd of March 2021. So we did have this problem for a while where the employee needed to be in place before October 2020. And if the employee was employed in, say, November or December, then you couldn't then put them on the furlough scheme. However, as long as they were employed before the 2nd of March and a PAYE real-time submission had been made to HMRC, including that employee by that date, then you can now put them on from May, you can put them on to furlough and claim that furlough grant for them, which is a bit of a relief for some employers as well. So the next part on the COVID business is the self-employment income support schemes. So the budget last month confirmed that there was a 4th grant, which was based on pretty loosely the same as the previous grants, which was 80% of 3 months average trading profits. So as you'll know, if you're self-employed or a number of partnership and have been affected by the crisis, you can claim for a taxable grant through the self-employed income support scheme. We got more details on the 4th grant in the budget. This covers the 3-month period, as I've said, from 1st of February to 30th of April. And can be claimed from late April. And I believe that in order to claim, the HMRC will be contacting those who do qualify and giving you a sort of a date on which you can then go onto their website and apply for that. And provided you filled in your tax return for the year to 5th of April 2020 and you submitted it prior to the 3rd of March, then you will be considered for eligibility on this grant. HMRC will first look at the 2019-20 tax return to check that profits are no more than 50,000 and at least equal to your non-trading income. And if you're not eligible from that test, they then do a second test where they look back at the 3 years from 16-17, 17-18 and 18-19. You must also have traded in the tax year to 5th of April 2020 to 5th April 2021. So you also must still be trading at least up to the 5th April 21. You must be currently trading as well, but are impacted by reduced demand or have traded but can't at the minute. So again, being able to demonstrate that to HMRC is something we need to consider before applying for these grants. And you also have to believe that there will be a significant reduction in your trading profits due to reduced business activity, capacity, demand, or inability to trade due to COVID, which will apply to quite a few of you on the call today. In the same budget, there was also an announcement on the fifth and final grant, and it will be determined on how much your turnover has reduced in the year from April 2020 to April 21. So the fifth grant will be worth 80% of 3 months average trading profits, capped at £7,500 for those with turnover reduced by 30% or more. 30% of the 3 months average trading profits capped at 2,850 for those with reduced turnover by less than 30%. So if turnover is reduced by 30%, you'll get £7,500. If it's less than 30% your turnover has reduced by, then it will be 30% of the average of 3 months capped at 2,850. So maximum grant available there in both cases is either £7,500 or £2,850. Okay, just very briefly on the coronavirus loan schemes. Again, probably not new news to many of you, but there's been a range of different funding options available for business since the pandemic began. You may have seen this morning's or the news earlier that the Scottish Government's website that 533 million has been paid to Scottish businesses since the introduction of the strategic framework on the 2nd of November. UK government guaranteed loan schemes that have been about for a while now, the Bounce Back Loan Scheme and the Coronavirus Business Interruption Loan Scheme, were extended to the end of March 21, which obviously we're past now, but just for reference. A new loan scheme has been announced to replace these when they ended in March. It's the Recovery Loan Scheme. And this will give lenders a guaranteed 80% of the government 80% from the government on loans between £25,000 and £10 million. It's open to all businesses, to include those who have already been supported under the existing schemes. It launched on the 6th of April and is open until the 31st of December this year. You're eligible if your business is trading in the UK, is viable or would be viable but for the pandemic and has been impacted by the pandemic. The finance terms are up to 6 years for the term loans and asset finance facilities. For overdrafts and invoice finance facilities, terms of 3 years. And there's no personal guarantees for facilities up to £250,000. Therefore, that's the updated loan scheme that is still available there. As many of you will have breathed a sigh of relief when this was introduced, is the business rates relief that was in place for the whole of last year up to 31st of March. As you probably all know, the business rates are devolved to the Scotland, Northern Ireland and Wales, and therefore it's the Scottish Government that we need to look at for any extension here. And that's where things can get a bit hazy at times when we're sitting watching the news and they're speaking about these things. Obviously, often they're speaking about the English side. But with the Scottish side of things, there was an extension to the relief for retail, hospitality, leisure and aviation sectors until the 31st of March 2022. So we have that through at least until March next year. And in England, that was extended until June 2021. And whether they extend that further at this stage, we don't know, but obviously that doesn't apply in Scotland, so that's okay. And then my final slide here is just a link of some useful links that you might want to make a note of, or I know Laurie's recording this, so you'll maybe have this available later, but there's some links here that will allow you to look at the various supports out there and keep an eye on them. It is a changing landscape and something that you probably want to maybe subscribe to emails for updates and things like that as well. So that's my brief update on where we are with COVID support. And now what I'm going to do is I'm going to hand over to Tony, who'll take us through some of the land tax and the VAT side.
Thanks, Scott. Yeah, absolutely. I'm going to quickly go over some of the land tax stuff first. So if we can go to the next slide, if that's okay. Just very quickly, stamp duty land tax, there was a bit of an update in the budget this year for that. But in the terms of the point that Scott was making, we've got to be careful. We're mindful of what's Scotland and what's rest of UK or England. So just to be clear about it, if you hear about stamp duty land tax, that's down south essentially. And what was announced at that point is a temporary increase in the SDLT nil rate band for residential property. And essentially from July until September, the nil rate band is going to be 250k. And then it's going to go from 1 October 2021 to the standard amount of 125. So right now, 500, 250, 125, there's a bit of breathing space in England if you're buying property. If we go to the next slide, we can see the Scottish specific piece. Similar to business rates, it's devolved in Scotland. So we used to have stamp duty land tax. We now call it land and buildings transaction tax. And ultimately, we've had some, movement whereby the thresholds have now returned to their previous rates. So from the 1st of April, i.e. this month, we're back to normal in Scotland. So a little bit of a disadvantage. How relevant this is to anyone on the call, I'm not sure, but it's certainly one that's being talked about. And as such, I just thought it'd be worth very quickly flagging that, there is a difference between England and Scotland. We are now back to the normal rates in Scotland. If we can go to the next slide, Scott, the real focus for me today really is the VAT. I think the first part especially will be particularly relevant to probably everyone that's on today. And it's about the 5% reduced rate VAT extension. Now, what this applies to is hotels and holiday accommodation, hospitality and admission to certain types of event. So I think that most, if not everyone in this call, can tick those boxes. It is quite far-reaching, but I would caveat that it doesn't involve alcohol. As we're getting nicer weather, etc., it'd be nice if the extension did go that far, but it doesn't. But it does apply to things like overnight accommodation, including camping, and it applies to meals in cafes, restaurants, bars, or even takeaway food. And it also includes admission to attractions. If you've got, for example, a tour that you operate, it could be liable to 5% VAT right now rather than 20% VAT. If we go to the next slide, what we can do is look at just a little bit of plotted background history here with the timeline, because historically 20% VAT has applied to all these activities. So whatever you charge your customers, you've got to either add 20% on and pass that to HMRC, or you take what you're charging your customer and you work out the VAT from that. And until the 14th of July last year, it was 20% standard rate. From 15th of July last year through to the end of March this year, the plan was to have the 5% reduced rate for those items that I just mentioned, which was seen widely as good news. But at the budget last month, it was announced that there was going to be an extension to the end of September. And then from September, we were going to have a new reduced rate of 12.5% for these activities. So I'll come on to some more commentary in a moment, but we're seeing a bit of a creep up the way again. So that 12.5% will cover 1st of October through to the 31st of March. And then from the 1st of April next year, it's going to go back to normal. And the idea is that means it'll be 20% thereafter. Now, you will note that I've got a few little dots beside the 1st of April 2022 measure, because there are a lot of bodies that are essentially trying to get an extension of the reduced rate for good. In mainland Europe, it's commonplace to have a reduced rate of VAT if you're buying a meal or if you're staying over in accommodation. And a lot of people have been campaigning for a reduced rate for a long time. I'll go to the next slide actually and give you a bit more commentary on it. Is this good or bad news for your business? Well, at a high level, it's good news that the Chancellor extended the reduced rate with 5%. It's better than it going to 20%, isn't it, right away? But that said, it all depends on your view of the world. It might well be you're someone that was actively involved in the campaign to get it extended forever at 5%. So you might view it as bad news for now. But that said, it's 5% for now, 12.5% from September, and then it's going to revert to 20 unless there's a good campaign to keep it down. It's worth pointing out that now the UK has left Europe. One of the good points about Brexit, I suppose, is that there's more control for the Treasury to decide what VAT rates apply. And they could really say, well, we really want to invest in the hospitality and tourism sector. As such, we will extend a reduced rate there. But I suppose that remains to be seen. And I dare say people involved in this call will be keeping an eager eye and even participating in such campaigns. Now, in terms of what you do with the reduced rate of VAT, it's up to you. You can either pass on the reduction to your customers, or you can benefit from it. And what I mean by that is, say you're running a restaurant and you're charging 12 quid for a burger and chips. You can decide, well, do I just keep it at 12 quid and I pay less VAT over to HMRC from that? Or do I reduce that £12 burger and chips to the amount that involves 5% VAT? There's not a right or wrong answer. It's up to you. And HMRC would tell you that as well. You've got to decide how you price your product. All they care about is getting the right amount of VAT for that product. So there's a little bit of scope to play about with your pricing, perhaps, depending on your outlook on it all. In terms of what's the tax point, well, the tax point, in simple terms, is when do I work out what VAT I've got to pay? So pretty much standard is that if you receive a payment, you've created a tax point. If you issue a VAT invoice, you've created a tax point. So what I mean in practice is, if you take a booking today for an overnight stay from someone and are going to stay over next Easter, the 5% VAT rate will apply if they pay today. It doesn't matter that, you know, the rate's going to go up to 12.5% in September until the end of March. It doesn't matter that it's going to go to 20% on the 1st of April, it seems, and will be 20% thereafter, including when people are staying over. The key point is, if you take a booking, if you receive the payment or you issue a VAT invoice for your supply just now during the 5% spell, then it's 5% VAT that applies. And I suppose commercially, be it just now while we're at 5%, or once we're up to 12.5%, you may look at things and think, well, is there an angle here for me to try and motivate people to book before a certain date or buy my product before a certain date? But that's really one that's for you to decide, but the VAT rules certainly permit that. If we look at the next slide, Scott, you know, we're going to move on, I suppose, to more generic stuff that might be helpful for your business. So this slide here talks about the VAT deferral period. Essentially, for a VAT return period last year, if you were due to pay HMRC, you didn't have to make the payment, you could defer it. And at the time, the idea was that you'd have to repay it by the 31st of March this year, 2021. But then a new option has arisen, and that option is you can sign up to pay that deferred VAT by instalments up to next March. So rather than taking the massive hit up front, you could defer that hit and pay in installments, as many as 11 installments. I would caveat that they're dwindling down as time goes on. We're now into April, obviously. So ultimately, if you have got a situation where you've deferred a VAT payment to HMRC in spring 2020 and it's still outstanding, you can either pay the full amount now or up until the end of June, or by the 21st of June, you can sign up in order to take advantage of essentially direct debit payments where you're paying in installments to help with your cash flow. If we look at the next slide, that's kind of turning it around completely, actually. This is for people that either have always been in a VAT repayment position or they're now in a VAT repayment position because of a change in trading patterns. And what I mean by that, quite simply, is when you submit a VAT return to HMRC, do you get a refund? That's what I mean by a VAT repayment position. Now, some people are aware that you can do monthly returns. And what that means is, rather than doing a VAT return every quarter, which is the norm, you submit a return every month. So you've got an added admin burden on yourself, but at the same time, you're increasing the frequency. You're expediting your cash flow by getting your refunds from HMRC much quicker if you go into monthly returns. And it is quite simple to opt in on HMRC's website to change to those monthly returns. So it's really about doing a bit of a, I suppose, a cash flow analysis, cash benefit analysis, cost benefit analysis, to say, well, you know what is it I've got here? Do I want to have the admin burden to get a bit more money back, or would I rather just do it quarterly and reduce the admin costs, albeit I'm missing out on the cash benefit? Again, it's one that's for you to decide as a business, but it's certainly an option that's available to you if you're in a regular repayment position. If we look at the next slide, Scott, the VAT thresholds, we've got a bit of certainty for the next few years. it's a bit of a standard thing for VAT registration thresholds and deregistration thresholds to fluctuate. And it used to be the case that they would typically go up £2,000 every budget. They've been frozen for a few years now, it feels like. And at the budget this year, the Chancellor confirmed they're going to remain the same until the 31st of March 2024 at the earliest. So what does this mean? Well, it means that you know for a fact, if I'm below the threshold, I don't need to worry about it until I'm over £85,000 of sales. But equally, if I'm above the threshold, I know that 83,000 is the number I've got to get below before I can deregister from the VAT club. There's good and bad to having a bit of certainty. You know, some people were a bit concerned that the Chancellor might reduce the VAT registration threshold to something like, you know, £10,000. And that would widen the base of people paying into the VAT system. But I think it's good news that people have got certainty that they won't be captured by VAT if they aren't already. Similarly, I suppose we've got certainty about when you can leave the VAT club or not. You've got to go below the 83,000 amount. So how that affects your business, again, it just depends on how you're trading. But it's certainly one to just be mindful of. There shouldn't be any nasty surprises, at least for a few years, in terms of when I must register or when I can deregister from VAT. If we look at the next slide, Scott, there's going to be a change to the VAT penalty system next year. And no one ever likes talking about penalties, but it's worth bringing up because it's going to be a fairer system, it seems. As it stands, if you're late with paying a VAT return, it means that you're going to get a penalty if you're a day late. Ultimately, going forward, there's going to be a bit of a points-based system, so it means that you shouldn't be unfairly charged a penalty, which could be as high as 15% of the VAT that you've been late paying, even if it's just 1 day late. So this is to align us with other taxes, and also to try and make a more consistent and fairer approach for everyone. And if we look at the next slide, this is, you'll be glad to hear, probably the final slide from a VAT perspective. I just want to cover off Making Tax Digital. As it stands, Making Tax Digital went live a couple of years ago. And if you were over the VAT registration threshold, it meant you had to comply with the MTD rules. You had to essentially use bridging software to transport your information over to HMRC's system. From this month, there's now a digital links requirement, and that has been introduced now. And it means that you've got to ensure you tick all the digital links boxes, i.e., you're not supposed to copy and paste stuff or, you know, have manual intervention with your VAT accounting packages. So that's something that you should be aware of, hopefully, if you are VAT registered and MTD for your VAT accounting. But going forward, it's going to be widened out. The base is going to essentially open up to anyone at all who's VAT registered. So from the 1st of April next year, unless you're an insolvent business or there's a religious society involved, which is quite a narrow population, you will have to use MTD processes for your VAT. That's something that might be a bit of a big change for you. You might not be familiar with it, but it probably sounds scarier than it is. You know, experts like Scott and his team help people all the time with getting configured for it. So it's just worth being aware of what are the current changes if you use MTD, i.e. the digital links. And going forwards, do I need to worry about this from next April? So that's a bit of a whistle-stop tour of that. But now you're not away from tax, because I'm going to pass you over to my colleague Nicola, who's going to update you on some tax stuff.
Hi, this is Nicola. Nice to be here with you this afternoon. I'm going to chat to you on some personal tax and also some corporate tax matters. So first slide, please, Scott. So starting then with the personal allowance and tax bands for the current tax year, reiterating his promise to do whatever it takes to support people through the continuing COVID pandemic, the Chancellor's confirmed his commitment to his election manifesto pledges. So he's not going to increase income tax and national insurance rates for a good few years. He has instead increased the personal allowance for the last time up until April 26. So it's gone up for this current year from 12,500 to 12,570, and that will apply for this tax year right the way through until 5 April 2026. The personal allowance is set by the UK government and it applies across the whole of the UK, so it applies to Scottish taxpayers as well. And once your income exceeds 100,000, it's tapered at a rate of £1 for every £2 above the 100,000 threshold. So for the next few years, if you're earning more than £125,140, you would get no tax-free personal allowance. And you can manage that by making pension contributions and gift aid payments, loss relief, things like that. And there's ways you can manage that if it is appropriate to your circumstances. I've also included on the slide the rates for the UK. So those rates apply from a Scottish perspective in respect of savings and investment income. It's the Scottish rates that apply for earned income, self-employed income, income from pensions and property. And I'll come on to the Scottish rates in a minute or two. The rate at which you pay high rate tax on saving income has increased only slightly. So the 50,000 threshold for Scottish taxpayers, which includes the personal allowance, is now 50,270. And again, that will also stay frozen now through until April 2026. So the impact of freezing the allowances and thresholds is to increase the government's tax take, but gradually. So as people's income increases over the period, the Treasury estimates that it will get in an extra 19 billion in tax revenue. So that's the objective there. Next slide, please, Scott. So this is the starting rate for savings, and this is something that is only applicable if you've got relatively modest levels of income. So if your income from non-savings is more than 17,570, this won't be applicable to you. But if your income is between 12,570 and 17,570, savings income such as interest that falls within that band would be taxed at 0%. So it's in very sort of specific circumstances, and that will also remain unchanged for the foreseeable future. Next slide, please, Scott. So the marriage allowance. This is an interesting one, and it may be that you find yourself in a situation where you might be able to claim this when maybe you haven't before. And so it's just to be aware of it. It's only available in very sort of specific circumstances. So you need to be a couple that are married or in a civil partnership. Neither of the parties to that relationship can pay tax above the basic rate band, and a claim's got to be made. So it's not given automatically, you've got to make a claim for it. Now, there's a mismatch here in terms of how the rules work between the UK and Scotland. So in Scotland, the test of whether or not you pay basic rate is by reference to the Scottish rates of tax, which I'll show you in a second. Whereas in England, it's by reference, obviously, to the English, the Scottish, the rest of the UK, Wales or England, it's by reference to the equivalent rates that apply in those areas. So that means that for 21-22, if your taxable income is above 43,662, then you will be not eligible to marriage allowance. However, if it is something that's available to you, it's worth looking back and thinking about whether you could have claimed it in a prior year, because you can go back up to 4 years, so it could be worth £1,000. So it's something that's worth thinking about if you think it might apply to you, not to miss out on it. Next slide, please, Scott. So this is the Scottish rates and bands. I'm not going to go through them line by line because there's quite a few of them. It's a little bit more complicated than the UK equivalent rates. The key point here is that the starter and basic rate bands have been increased by inflation, but there's no other changes other than consequential movements. And so the tipping point now, so whether as a Scottish taxpayer you would pay more or less income tax than someone, say, living in England or Wales, that tipping point is now 27,393 for 21-22. So up to that point, you're slightly better off, only very slightly. And as your income gets above that, you start to see an increase in the amount of tax that you will pay. Next slide, please, Scott. This is the savings allowance. So this applies to all UK taxpayers, and it's by reference to the UK rates and bands, whether you're a Scottish taxpayer or otherwise. And if you're a basic rate taxpayer, you'll be allowed a savings allowance of £1,000. So that will cover interest, purchase annuities, policy gains, things like that. As a higher rate taxpayer, it's £500 that you're allowed. And if you're an additional rate taxpayer, so if your income is above 150,000, you're not entitled to it at all. And just an important point to note that the income that falls within the savings allowance, and this is also the same with the dividend allowance, does form part of your total income for determining whether or not you are a basic rate taxpayer or a higher rate taxpayer. It's not an exemption to tax. It's just that the income within that band is taxed at 0%. Next slide, thanks. So the dividend allowance, just to say that this is £2,000 still. It was 5,000 when it was very, very first introduced, but it's been 2,000 and will continue to be 2,000 for the foreseeable future. Next slide, please. I'm not going to say very much on inheritance tax, but just next slide, please, Scott. Just to say that nothing's changed. So mostly nothing does change with inheritance tax. It's one of the areas I do quite a lot of advice on, and it's been very sort of stable, I would say, and that nothing's changed for many, many years. We were expecting there might have been some changes. There've been some papers that have been issued by the government around potential changes, but ultimately nothing's happened. I guess there's other more important things going on at the moment, perhaps. The only thing that was slightly surprising, although not really in the context of everything else that was announced, is that the residential nil rate band was frozen at 175,000. That was introduced a few years ago, and when it was introduced, it was said that it would increase this year in line with inflation and would continue to increase over time. The residential nil rate band is an extra bit of nil rate band that's available to estates, and it's to help pass on the home free of inheritance tax. That's the idea behind it. So you can leave your house to your children, and up to a value of 500,000 now, or £1 million per couple, would be IHT free. So that's been frozen at 175,000, and all other IHT rates have remained the same. So there's been no changes. Next slide, please. So on to employment tax now. I'll just go through these slides relatively quickly. The NIC thresholds have been increased for inflation, the CPI. So the primary threshold is increased to 9,568. So that's the level of income at which you trigger a liability for an employee to pay national insurance at 12%. And upper earnings limits increased to 270. So you can see that aligns with the UK higher rate threshold. And that's going to remain aligned up until April 2026. Next slide, thanks. National living wage and the national minimum wage. I'm not going to go through this line by line. The key point here, and just to kind of sort of pull it out for you, is that the national living wage will increase to 2.2% and will also be extended to 23 and 24-year-olds. So if you've got anybody in your employment who might fall within that bracket, just to be aware that their rate will have gone up on the 1st of April. I'm sure you probably are well aware of it, but just in case, for completeness. So they would have been on £8.20, but obviously now that will have increased. So just to be aware of that. Next slide. So on cars, there's been a bit of a move. So company cars were less popular. So if you're a sole trader or a partnership, this won't be relevant. But if you've got you're a company or you're an employee yourself, then this might be of interest. The charges for a petrol or diesel car can be up to 37%. For electric cars, they can be as low as 1%. So they can be very attractive from a benefit in kind perspective in terms of providing benefits to you if it's your company or to your employees. So it's something just to sort of bear in mind. The rates are changing. Next slide, please, Scott. The rates are changing, and they're here, and you can see that there's a general movement up the way, even including on the electric cars. So things are changing, but they're still much more beneficial than petrol and diesel cars. It's just something to be aware of if you're looking to replace cars at any point. Next slide, please, Scott. Off-roll payroll working. So this is only relevant in some circumstances. Sorry, I'm just trying to find my notes. I found them now. So these are new rules which came in on the 6th of April this year, and they apply where there's an individual, a worker, so someone that might be providing services to your business, and they're doing that through an intermediary. So they're not your direct employee. They might have a personal services company, or they might have come through another person, an agency, for example. So in some circumstances, you need to determine whether or not really they're your employee effectively from a tax and national insurance perspective. Next slide, Scott. So there needs to be a status determination made if these rules apply. Now, for many people, these rules will not apply because you can see that small organisations are exempt. So if there's if you have an annual turnover that's less than 10 million, 10.2 million, your balance sheet's less than 5.1 million, and you've got less than 50 employees, these rules would not apply. But if someone that is a worker in the context of your business comes to you and asks you, are you a small organisation for purposes of these rules, you do need to be forthcoming and give them that information, because they'll need to have that information to be able to determine whether or not it's appropriate for them to make their own determination of the position. So you do have some obligation under the new rules, but the onus would be on the worker themselves or their intermediary. Okay, next slide. So coming on to business tax then, corporation tax is currently 19%. And from April next year, that is going to increase to 25% for companies that have profits over 250,000. If your company has profits of less than 50,000, then you're still within the small profits rate, which is going to be set at 19%. So that would be no change for your company. And if you're somewhere in between the 50 and the 250,000, the effective rate of tax on the profits in that band would be 26.5%. So you pay 19% and then 26.5%, and effectively then you'd be 25% on the profits over the 250 mark. Just to be aware that when you're testing those thresholds, you look at associated companies. So this is something that we used to think about a lot in tax a few years ago, and it disappeared when we had just one rate of corporation tax, but now it's back again. So if you've got two companies, both of which you own, then you would need to apply those thresholds to both of the companies. So it'd be 50,000 profits across both companies. Or if it's a group, so you've got one company owning another company, then you'd have to look at the profits of the whole group to determine whether or not which rate of tax would apply. Next, thank you, tax losses. So we have an extension to tax losses, and this applies for both incorporated and unincorporated businesses. So for company accounting periods, it applies for the period 1 April 20 to 31 March 2022. And for unincorporated businesses, it's 2021 tax year and 21-22. So currently there's a 1-year entitlement where you can carry back losses in some circumstances, and that's going to be extended to 3 years. So, if you've had a tough time and you've got losses over this period, then you're able to carry them back and hopefully get some tax refunds, which obviously will help with cash flow. The first year is unlimited, but the carry back for the next 2 years, so going back up to the 3 years, would be limited at 2 million, and that applies for groups of companies as well. So again, it's 2 million per the group, not per each individual company. And the cap is per accounting period. So it's not 2 million across both of those years. So very valuable relief if you found yourself in that situation where you have incurred losses over the period. Next slide, please, Scott. This next one is just for companies, and the Chancellor had unveiled what he calls the biggest tax cut in modern British history. And this is what's known as a super deduction. So you probably heard about this in the news. So it puts the UK's capital allowances regime as one of the most competitive in the world. Obviously, this will be for a relatively short period of time, but it's incredibly valuable. Between 1st April this year and 31 March 23, companies, and it is only companies only, will be able to get 130% deduction on most new plant and machinery investments. So these are the capital allowance items that would normally have qualified only for 18%. So essentially the tax bill will be cut by 25 pence for every £1 that we spend on qualifying plant and machinery. And there's no cap on it either. So annual investment allowance, which applies to unincorporated businesses, because they'll continue to get the annual investment allowance, there's a cap there of £1 million, but there's no cap on the super deduction. It applies for contracts that were entered into after budget day. So and the spend needs to be incurred after the 1st of April to meet the timing condition. So there's a little bit, and there might be some people that might potentially miss out if they'd already contracted before the budget. And there's also a 50% first year allowance if the plant machinery would only qualify for the 6% writing down allowance. So there's relief for other items there available too. Okay, next slide then, thanks. Research and pensions. Oh, so now we're over to Frank. Thank you.
I think you might be on mute, Frank.
Classic Zoom failure. You're on mute. Yeah. Good afternoon, everybody. Thanks for dialing in. I've got the shortest session of the afternoon here, just a few key financial planning points that I'd like to run through. Could you take up the next slide, Scott? Thank you. So as you can see here on pensions, the big news is that there's no big news, that there's no changes as such. Tax relief hasn't been changed. There's lots of talk that they were going to do something with that. But there has been lots and lots of talk for many budgets before. But effectively, tax relief remains the same, thereby making pension planning a very attractive savings proposition. The annual allowance is the amount that you are able to pay into your pension each year. Allowance remaining at £40,000. But there is a carry forward allowance. So technically, an individual could pay in up to £160,000 in any one tax year to sweep up the 40,000 current year in the 3 years previous. But there are some caveats around that. They would obviously need to either have enough income to justify that level of contribution, or alternatively, the contribution would need to be made by a company for their employee. It's very popular with directors where the company owners, they maybe had a very good year and they're able to make a significant contribution from the company into pensions for themselves, thereby reducing corporation tax and boosting their retirement savings as well. There's no changes to the current taper relief. The taper relief only applies to very high earners. If you fall into this tax bracket, it is something you should be very careful of, and make sure that you get suitable advice to make sure that you are doing what you can to make the most of the tax relief that is available to you, that you are working within the guidelines. Could I get the next slide, please, Scott? The flip side of building up the pension funds is what you do with them when you get to retirement. There is a lifetime allowance on pension contributions that has now been frozen until April 2026, and you can see there that it's at £1,073,000. It's a significant figure, but many people are very close to that currently. Some would have exceeded it. Again, if you are going to be in a position where you will be getting close to that in the next few years, or you are already there, again, make sure that you take advice on it, because the tax penalties when you exceed the lifetime allowance are pretty significant. The money purchase annual allowance, that stays at £4,000 now. But what that actually is a reduced allowance. The annual allowance, as we noted in the previous slide, £40,000. But if you flexibly access your pension benefits, say for instance, you were to start to draw money from a pension plan, but you also wanted to continue to contribute, your contribution allowance would then be capped at £4,000. So again, very worthwhile taking advice on this if it is something that is going to affect you. There are ways to mitigate this. For instance, you could maybe only take tax-free cash out of your pension pot. That won't trigger the money purchase annual allowance, and that may be adequate for certain people to still allow contributions to be made at a higher level for maybe a period of years until they fully retire. Next slide, please, Scott. Investment allowances, then get the next one, please. So main investments here that we're looking at, ISAs, everybody has an ISA allowance of £20,000 a year that can be split between stocks and shares and cash. And ISAs are transferable between providers as well. Lots and lots of people have built up very, very significant ISA portfolios. A lot of them would be sitting in cash now are not doing very much, so maybe a transfer to a stocks and shares plan at a suitable risk level would be worth considering. Again, if you are either interested in ISAs or you already have an ISA portfolio, make sure that it's reviewed so that you are getting the most out of it. Lifetime allowances, or rather lifetime ISA allowance, the lifetime ISA allowance is not actually one that seems to be taken up all that often. It's actually an interesting one because you've got a 4,000 contribution allowance, which is annual. It does form part of your 20,000 full allowance, and it would allow somebody up to the age of 40 to potentially be saving for a house deposit or longer term for additional retirement planning. The government give a very attractive bonus on this of 25%. So very well worth looking into if you are either looking at a first-time house purchase or alternatively some additional pension planning. Don't view it as an alternative to pension planning if you are looking at it as long-term, but certainly in tandem with proper pension planning, it could be quite a useful way to build up another pot of money for your retirement. The junior ISA allowance of 9,000, again, as you can see, everything remains the same. That is a children's allowance, very popular with parents, guardians who are in a position to contribute that sort of money for the child's future. Again, it can be split between cash and stocks and shares. When the child turns 18, the money becomes theirs, so you need to be mindful that they will have access to it at that point. But again, big attraction of ISAs, the money is going to grow through any income or capital gains tax. So as a savings option, they should be at the forefront of your thoughts. Could I get the next slide, please, Scott? And lastly, Green National Savings and Investment Product. Now, there's been a lot of talk about this, but as yet, it's not actually been finalised what we are going to have here. But the principle behind it is that government-backed, issued through National Savings and Investments, and it's something that the government are looking to raise money through to help them meet their net zero carbon emissions by 2050. The projects will include onshore, offshore wind farms, accelerating the transition to electric vehicles, and revamping homes and public transport. As with all national savings products, your cash is 100% backed by the British government, which, given that depositors' protection schemes only take up 85,000, is again attractive if you have that level of money. We don't know as yet what the amounts on this are going to be. and we don't know what the rates are. That is all news to follow, but potentially something that could be very, very attractive, because the thinking at the moment is that the rates on these may be better than you might find elsewhere on cash, but again, there is probably going to be a tie-up of a period of years. And that is everything from me. Thank you.
I think there was one more slide there for you, Frank, the mortgage
Oh,
guarantee.
so one, I thought that was me through the guarantee. Forgot about that one, yes. Sorry. Mortgage guarantee scheme. That again, new initiative, introduced this month and available for new mortgages through to December 2022. The guarantee is there for lenders with who are taking on borrowers with lower deposits. 5% deposits used to be very, very common years ago. Deposits have been significantly higher over the last few years, making it much harder for younger people to go on the housing ladder. So this is a way of the government encouraging lenders to lend to people with smaller deposits. Homes up to a value of £600,000, not much of an issue for us up here, but down south, that's probably maybe a one-bedroom flat in certain parts of London, such like. And there will be fixed rates available for up to 5 years. So again, for people who are in the right end of the market for this, this is a really good scheme that's been introduced. That's been nice, Scott, I think.
Thank you, Frank. And thank you to Tony and Nicola as well.